S&P futures are up 0.3% this morning. The Nasdaq 100 is ticking 0.4% higher. We're looking at a tentative relief rally in the overnight session following Monday's brutal 1.7% Dow sell-off.
Right, which pushed the S&P 500 negative for the year yesterday.
Exactly. And the VIX remains stubbornly elevated, so do not let those green arrows on your pre-market screen fool you. The bell hasn't rung yet, and we are dealing with some massive overhangs.
It's the classic wait-and-see setup. I mean, the market is trying to find its footing, but the ground is literally shifting beneath us. You've got bargain hunters picking through the wreckage of that AI scare trade from yesterday, but
the conviction just isn't there.
Not at all. And frankly, looking at the macro picture today, it really shouldn't be.
Yeah, because we have two huge catalysts parked right on top of the price action. First, the policy hammer finally dropped. Tariff Shock 2.0 is officially live.
Midnight last night?
Right. As of midnight, that 15% global-based tariff under Section 122 is in effect. Now, we cover tariffs all the time here, but Section 122 is being called, a liquidity drain. And normally, taxes just mean lower margins, not an immediate liquidity crisis.
Right, and that's the dangerous misconception retail traders are making right now. Section 122 isn't your standard trade adjustment. Under these specific rules, importers have to post cash bonds immediately upon entry.
Or full amount.
For the full amount of the potential tariff liability. Usually you have grace periods, right? You have credit lines.
Okay.
Section 122 demands cash up front.
So it's a pure capital freeze.
Exactly. It pulls cash directly off corporate balance sheets the moment a ship docks at the port. That is working capital that, it can't be used for buybacks, it can't be used for R&D, and it certainly can't be used to pay dividends.
It just sucks liquidity out of the system instantly, which perfectly explains why the market feels so incredibly heavy despite the futures showing green.
Yeah.
And then we have the second catalyst today, the political side. High-stakes State of the Union address tonight. The expectation is that we're going to get details on further trade restrictions.
Which means you have a market that is essentially holding its breath. We are one headline away from a total trend reversal. The floor could fall out, or, potentially we get a relief rally if the speech is milder than expected.
But right now, risk management is the only game in town. So for you listening, the question is, are we at the bottom, or are we just standing in the eye of the storm?
To figure that out, you really have to look at the macro overlay first, because the data this morning is showing some serious headwinds. We're looking at the double tax on growth scenario.
Yeah, the 10-year yield is rebounding to 4.05% this morning. It's totally reclaiming ground after Monday's brief flight to safety.
And simultaneously, the dollar index, the DXY, has climbed to 97.81.
Okay, let's unpack this double tax concept for a second. We hear strong dollar, high yields, and everyone just sort of nods along. But why does this specific combination spell disaster for high-duration software stocks?
Well, it hits you from both sides of the ledger. First, that stronger dollar, the DXY at 97.81, it eats into overseas earnings. That is your first tax.
Because if you're a multinational tech giant, your goods just got way more expensive for the rest of the world.
Exactly. Or your repatriated profits are just worth less when you bring them home. That hits the E and the PE ratio.
So your earnings per share drop just on the currency conversion alone.
Correct. And then you have the second tax, which is the higher yields. When that 10-year Treasury yield spikes to 4.05%, it compresses the multiple you're willing to pay for those exact same earnings.
Right. Basic discounted cash flow math.
Basic math. Future cash flows, which is exactly what you were buying with a growth stock, are worth less today when the discount rate goes up.
But wait, hold on. We've known yields were creeping up for weeks now. Why is today's move to 4.05% suddenly the panic button? Hasn't the market priced this in already?
That is the mistake everybody makes. They think it's priced in, but it's the rate of change that breaks things. When yields spike in correlation with tariff fears, it tells institutional desks that the market is prioritizing inflation protection over growth safety. This is a mechanic that severely punishes dip buyers.
Because if you are stepping in to buy the drop in tech just because it looks quote-unquote cheap historically, you are fighting a macro current that's actively revaluing what cheap even means.
Precisely. The definition of fair value is dropping faster than the stock price itself.
That is comforting. Well, speaking of fighting the current, let's dive into the sector taking the hardest hit today. We have to talk about the SaaSpocalypse.
I love that term, even if it is terrifying for portfolios.
It's our deep dive theme of the morning. Tech is just looking like the most vulnerable asset class on the board today. But what's fascinating is the narrative shift. It's not just the White House or tariffs. It's anthropic.
Yeah, this is the displacement narrative finally taking hold.
What?
We've been warning about this structure for 6 months. The release of Claude Code and these new agentic AI tools, they are fundamentally gutting valuations for seat-based SaaS companies.
But play devil's advocate for a second. Usually, when a new tech comes out that makes workers more productive, the companies selling those tools make more money. Why is a better AI tool tanking software stocks?
Shouldn't Salesforce and Adobe be thrilled? Right.
Exactly.
Not this time, and here's why. It breaks the fundamental equation of SaaS. For 20 years, software revenue was directly correlated to human headcount.
You sell seats or licenses.
Right. If a company grows and hires 1,000 employees, you sell 1,000 Salesforce licenses.
The per-seat model, the holy grail of recurring revenue.
But these agentic AI tools, like Claude Code, are designed to do the work instead of the human, not just assist them. If an AI agent does the coding or the data entry or the level 1 customer service, you simply don't need those humans.
If I'm a CTO and I replace 50 junior devs with one AI agent...
You don't renew those 50 software licenses. You might pay for one intense compute license, but the volume collapses entirely. The market is waking up to the fact that the system of record model, where you pay a monthly fee for a human to log in and do work, is being aggressively repriced. It's being viewed as a victim of the AI era, not a victor.
So the valuation shift is basically moving from headcount times license fee to what?
It's moving to compute times outcome. And the really scary part is we don't know what those margins look like yet. That uncertainty is why the PE multiples are shrinking.
The market is pricing in a future where software is a utility, not a premium service. We saw this with IBM's recent 13% crash.
That was ugly.
Beyond ugly.
But it was a wake-up call. Legacy IT and B2B software are being treated as ghost GDP right now.
Ghost GDP.
Yeah, companies that look productive on paper, that have huge install bases, but structurally they are obsolete. And that realization is driving a massive sector rotation today.
We are seeing that rotation on the board this morning pre-market. Tech and financials, specifically the XLF, are seeing money exit fast. But where is it going?
Energy and resources. The XLE is the clear standout today.
Which feels totally counterintuitive, right? Yeah. If we are worried about growth slowing down due to tariffs, usually if the economy tanks, oil tanks?
Normally, yes. But this is a defensive hedge against stagflation.
Right.
Investors are hedging against currency volatility and tariff-induced inflation. Crude is holding firm. Essentially, the market is screaming, I want real assets.
I want oil, I want mining, I want copper.
Exactly. I don't want a software contract that might be automated away in 6 months. This is a value over growth day, plain and simple.
So on one hand, you have the government squeezing the cost of doing business via tariffs. That's the external shock. But the bigger problem for tech is this internal shock. While they're panicking about import taxes, their entire revenue model is rotting from the inside out due to AI displacement.
That is a perfect way to frame it. It is a two-front war for tech right now.
So if you are looking at your screen wondering why your tech growth stocks are bleeding red while boring old oil is green, there's your answer. Now let's get into the specific movers, because despite the gloom, we have some massive pre-market gappers.
Volatility always creates opportunity.
Let's start with Keysight Technologies, ticker KEYS. This thing is ripping 17% higher pre-market.
And this is a perfect example of what we just discussed regarding the rotation into real things. Keysight delivered a massive double beat on earnings and revenue.
And for those who might not trade this name, Keysight makes testing equipment for electronics.
Right. They make the oscilloscopes, the network analyzers. They are the actual picks and shovels of the hardware cycle. See, you can use AI to write code, but you cannot use AI to hallucinate a voltage test on a physical chip.
You need the physical hardware to test the physical hardware.
Exactly. Physical atoms versus digital bits. If you are building new chips, new AI data centers, or 6G networks, you need to test that hardware. Keysight proves that the manufacturing renaissance is real.
While software is struggling, high-end electronic test demand is booming, but 17% is a huge gap up. Are we chasing this at the open? What levels are we watching?
The bull case needs to hold $295. If they can hold that level, they can push for the $300 psychological barrier. That would signal real, sustained institutional accumulation.
And the bear case.
If it slides under $278, that's a gap fill. Traders will see that weakness, lock in profits from the overnight jump, and walk away.
Which means dropping back down to yesterday's close, erasing the entire move. Got it.
Next up, we have VIR Biotechnology, ticker VIR. exploding 64% this morning.
Pure news-driven momentum here.
Yeah.
They just announced a landmark $2 billion oncology partnership with Astellas Pharma.
$2 billion will definitely wake a biotech stock up.
It does more than that. It validates their entire pipeline for metastatic cancer.
Yeah.
And think about the macro context. In a market like this, where liquidity is drying up due to those Section 122 tariffs we talked about, a cash injection of that size is a golden ticket.
It totally removes the bankruptcy risk for the foreseeable future.
Exactly. Now, on the flip side, we have Hims & Hers Health, ticker Hims & Hersen, tumbling 8%. This is the cautionary tale of the morning. They gave underwhelming guidance, which is bad enough on a day like today. But they also disclosed an SEC enforcement letter regarding their compounded semaglutide business.
That's the GLP-1 weight loss drug trade. They've been making a killing selling the compounded versions because the brand names are in shortage.
Right, but that business model is entirely built on a regulatory loophole. The FDA only allows compounding when those drugs are on the official shortage list.
And if the shortage ends or if the FDA cracks down, which an SEC letter strongly hints at, that massive revenue stream just evaporates overnight.
So they basically built a castle on sand.
Built a castle on a regulatory exception, yeah.
Mm-hmm.
This is a major red flag for the entire retail GLP-1 trade. Regulatory risk is the one thing you cannot model perfectly in a spreadsheet, and the market absolutely hates uncertainty.
And finally, we have to touch on the bellwether today. NVIDIA, ticker NVDA.
The AI fear trade bellwether.
It feels like the whole market sentiment is hinging on this single chart. We talked about the software side imploding, but NVIDIA is the hardware king.
It is, and NVIDIA is seeing extremely high pre-market volume. The market is trying to decide if that intelligence crisis report from yesterday, the one that sparked the sell-off claiming LLM scaling is hitting a wall, was real structural risk or just noise.
What are the exact lines in the sand here?
It must hold $148. If NVIDIA holds $148, it signals that the report was overblown and the buy-the-dip algos are still in charge. But, and this is the massive risk today, if it breaks below $135.
That sounds like a trap door.
A break below $135 confirms a structural shift. It moves the narrative from hype to disruption fear. If that happens, we could see a much deeper systemic correction across the entire semiconductor space.
That is the level where the institutions just start dumping.
Exactly.
So keep an extremely close eye on $135 on NVDA. Now, before the bell rings, we have a major retail earnings print to digest. Home Depot, ticker HD, is reporting pre-market.
The ultimate consumer health check.
The analysts are expecting a 19% EPS decrease, which sounds ugly.
Ignore the EPS.
Ignore a 19% drop in earnings. That seems pretty generous.
In this specific context, you have to. The market has already priced in a bad quarter. We all know the housing market is frozen. The algorithm is going to be reading the 2026 guidance. It's all about the forward look today.
So the risk here is simple. Does the guidance reflect a consumer pullback due to these tariff-led price hikes?
Precisely. If you're planning a kitchen renovation in 2026, you better buy the lumber today. Because if Home Depot comes out and says, hey, tariffs are making lumber and appliances 15% more expensive and people aren't buying, that's the signal.
I mean, I'm still paying off the lumber from my 2024 renovation, but point taken. The costs are being passed down.
And that is the macro signal we're looking for. If the consumer balks at the price, the soft landing narrative is dead. For the stock itself, the bull case needs to hold above $415.
Meaning the bad news is already priced in.
Right. But if we flush to the $392 support zone, that tells you the consumer is materially weaker than Wall Street thought.
Okay, let's zoom out to the broad market levels. We need to set the board for the day. You're calling this setup a liquidity trap.
That's the verdict. The S&P 500, the ES futures, are in a range-bound distribution phase right now. We are just trapped in a brutal 200-point range.
So what are the numbers? If I'm trading the S&P futures off the open, where am I looking?
For the ES, the ceiling, the hard resistance, is 6,865. We absolutely must reclaim this pivot to stop the bleeding from yesterday. The bulls have to recapture that hill.
And the floor.
The bulls are defending a fortress at 6,765. If the bears breach that wall, the road to 6,704 is wide open.
Why 6,704? You highlighted that in the research notes as a critical pivot.
Because a daily close below 6,704 invalidates the entire 2026 uptrend. It completely opens the door for a 5 to 10% correction. If we lose that level, the market structure breaks, it ceases to be a dip and officially becomes a downtrend.
Now, looking at the Nasdaq futures, the NQ. This is the epicenter of that SaaSpocalypse we talked about.
It is. Sellers are heavily stacked at resistance right at 24,841. That is the key pivot. If we can't get above that, the bears remain in total control.
And the support on the Nasdaq.
Immediate support is 24,280. But there is a massive trap here. If the NQ fails to hold 24,000.
The big round number.
Right. If 24,000 breaks, momentum algorithms will flip to aggressive shorting. That is exactly where the buy the dip crowd gets liquidated.
So putting this all together into a cohesive strategy for the implied open, you're calling this a liquidity trap. What is the actual play?
Fade the edges. This is not a day to be a hero. Sell rallies toward ES 6,865. Do not chase breakouts this morning. We need to see a 4-hour close above ES 7,000 before we can even begin to talk about a resumed bull trend.
And you have a specific warning for today about what you're calling the pain trade.
This is critical for everyone listening. The pain trade right now is retail investors trying to catch the falling knife in software services.
Because they think it's just a normal cycle.
Yeah.
Like, oh, SaaS is down, it'll bounce back in 6 months like it always does.
Exactly. They are conditioned to buy the software dip because it worked flawlessly for 10 years. But institutions are rotating out right now because they view this as a permanent replacement cycle. The system of record model is dead.
So when retail steps in to buy that dip,
They are simply providing the exit liquidity for the institutions who are getting out. Do not be the liquidity for the institutional exit today.
that is a sobering thought to start the morning. It's not just a bad day on the tape, it's a changing of the guard.
It's better to be sober than broke. This is a day to sit on your hands unless you see your specific predefined setup.
Fair point.
Yeah.
Before we sign off, make sure to keep an eye on the 10:07 a.m. Eastern Time slot. We have the Conference Board Consumer Confidence print dropping.
And given the Home Depot news we're waiting on, that data point could absolutely move the market.
Definitely. And remember the golden rule for today. Keep your position sizes small. The market is actively hunting for stops in both directions.
Volatility is the name of the game right now.
Keep your head on a swivel, watch those specific levels on NVIDIA and Home Depot, and do not fight the tariffs.
And don't fight the AI displacement.
Keep your eyes on the bell.